All right, so I'm going to go ahead and get started. People will join as they can. Thank you for attending our webinar with Kerber Rose on the new pandemic relief and how it will impact you. I have Chris Olson and Nick Hammer who are going to introduce themselves, and then they will go into their presentation. Thank you guys for being here.
Thank you, Mickey. All right, let's get started. Hello, everyone. Thank you for joining us today, and welcome to Kerber Rose's new pandemic relief and how it will impact you. We are excited that you all could be here with us today and learn more about the provisions within the new legislation. Now, before we begin, we just have a few housekeeping items. There is a Q&A feature available. If it does not appear automatically, look at the bottom around a bubble icon with a question mark on it. This will allow you to ask our presenters questions throughout the presentation. Now, don't worry if your question does not get answered right away, or if you think one after the fact. We do have space at the end of the presentation designated for a Q&A session. We want to remind everyone that today's presentation will be recorded and made available later for viewing. I would say please watch your emails in the coming weeks for the link to the recording or other news from your chamber. Now that we have those covered, my name is Christopher Olson. I'm a senior manager at Kerber Rose, and I've been here for the last couple of years, but I've been a CPA for the last, I'll say 11, 12 years.
And I'm Nick Hammer. I'm also a CPA here at Kerber Rose, senior manager position. I've been in public accounting for about 12 years. And so, you know, small to mid-sized businesses is really my realm. So go back to Chris and we'll get started here.
All right. Now let's just begin the presentation. All right. The new pandemic relief and how will it impact you? As you can see here is myself and Nick. If you have any questions or you want our contact, our email address is right here. And at the same time, we have our emails at the end of the last slide here during the question session. Today's webinar schedule will be discussing, the President Biden's tax policy. It is not part of the Consolidation Appropriations Act, but it's probably likely a good idea to cover that as it is a hot topic going on. We'll cover an overview of the CAA, or the Consolidation Appropriations Act, and within the provisions such as a new program or modified program to the Paycheck Protection Program. We'll cover the Employee Retention Credit. We also have a section on the shuttered venues operations, and then finally, other provisions within the new legislation. So currently, President Biden's tax plan or potential policy for individuals is he wants to increase the ordinary tax rate to 39.6%. As you know, that prior to the passage of the Tax Cuts and Jobs Act, the top rate for ordinary income such as wages, interest, potentially business income was at 39.6. And currently that current rate is now set at 37%. So likely you're going to see for singles and head of households, roughly you could potentially see maybe around $500,000 where that rate would would change. Married could be a little higher, around 630. In addition, President Biden's plan would be considering looking at a payroll tax increase. So currently, as we all know, 12.4% of Social Security tax is typically paid evenly between employer and employee on the first $137,000. It does go up every year based on inflation. Now, President Biden's plan would like to tack on an additional 12.4% on wages or even self-employment income in excess of 400,000. Now the question would be here is 400,000 of what is that? Does that mean single or is that married? Currently, we just don't have an answer to that. Capital gains is another hot topic. Income or taxable income, which we don't know yet, in excess of $1 million, your long-term capital gains or your qualified dividends would be then taxed at a rate at 39.6. Really matching the ordinary top marginal bracket.
And so there's some tax planning opportunities here that you probably should begin thinking about. So for example, if you have a Schedule C filed on your individual return, say you're a single member LLC or something, and you have income in excess of 400,000, this is going to hit that type of individual pretty hard, because now all of a sudden, what had previously just been taxed for Medicare, kind of above that Social Security threshold of 137, you could now get hit with that 400,000, or excuse me, the 12.4% over the 400,000, and so all of a sudden your tax burden could increase substantially. So you may want to look at different tax structuring, such as, making an S corp election.
Correct. And adding on to that, I do have a client that I'm working on that has some significant self-employment income, where potentially looking at this plan, not knowing all the details, but if we made an S election, potentially this client could see savings up to about $70,000 a year. So planning now and just asking those right questions with your trusted advisor, like, is my current situation ready for a change, especially if you're over that $400,000 limit. So, as well as the capital gains, you're looking at your $1 million mark as well. So, another potential change you could see is the qualified business income deduction, or better known to our profession, the QBI. We won't go too much into the QBI. That's a whole nother topic for another day, but the basic idea that your income, if you have a qualified trade or business, you could get a shave of 20% off the income. What President Biden's plan would be is the elimination of that 20% shave for incomes over $400,000. Nick, any comments, potentially thoughts on planning, or just, I would say just talk to your advisor. You potentially could accelerate expenses, if you're concerned about that in 2021. Anyways,
Right.
to drop that income down to under 400,000.
Right.
Especially if you're near that bubble.
There'll be some planning opportunities. There's always, some play with depreciation and things like that. So really just be aware that this could, and of course this is not law yet, but you want to be thinking about some of these things, as we move through 2021.
Correct. In addition, itemized deductions, for your higher earners, itemized deductions, prior to the Tax Cuts and Jobs Act, we call this piece limitation. Well, it's kind of bringing that back into place. So likely you may be in the 39.6 bracket, if there is going to be one. Would you be able to, accelerate all your deductions or your contributions, your itemized deductions? But likely those are going to be capped at 28%. So even though you're at the highest rate, you're only allowed 28%. So it's something to consider when you plan ahead. But like I said, nothing is law yet. So this is all speculation based on what we know so far. Also want to add about a retirement. Not too much here, but if you're making 30 or you're making 300,000, if either of them made $1,000 contribution, they're looking at generating a 26% credit, just making it even. So both would then receive, you could say, a $260 refundable credit.
Yeah, right. So this is going to be a big change. So let's say you're in the top tax bracket and you're used to maximizing your 401k. You were previously receiving the 37% benefit behind that. Now that's going to drop to 26%. So that'll be a change for you as well.
Let's see, as well as tax credits, there's the earned income credit, the child tax credit, and the dependent care credit. Guys, the proposal to expand those programs. So far, we've only heard just a little bit about the earned income credit. There's been news about a monthly payout for the earned income credit. The credit could be as high based on your dependent's age, your kid's age. So we'll just wait and continue to watch the news and see what comes out on these credits. They're definitely one of those topics that we want to be aware of. Of course, maybe another big thing for the estate, you probably have heard a lot about this, is the elimination of the tax-free or the step up in basis on death. So now what that means is it could say a death is now a recognizable or realization event. Pretty, you definitely an opportunity to start talking about your, it never hurts to always talk about your plan, estate planning. Look at down the road, see if your plan is set up for a what if scenario. There's also the exemption, currently it's around $11 million. We want to carve that or put it all the way back down to about 3.5 million. And as well as increase the maximum tax rate around up to 45%. So currently it's at 40, but now it would be jumping up to 45.
Right, so these are some big changes. So if you do have a plan in place and this does go through, it'll be important to talk to your advisor on kind of reworking some of your estate plan.
Corporate tax rate, there's also discussion about increasing it currently from 21% to 28%. And so just to add on to that, you could have a C Corp, that's at the 21. Maybe you are under the LIFO method and you're concerned about, you want to change it to the FIFO, but before you do that, it's definitely important to talk to your advisor because, well, I got those, this is potential planning for those manufacturers or maybe the automobile industries. But just the basic here is just to talk to your advisor about maybe look at your inventory. That's just one of many potential plans or thoughts that you could look at if you're a C Corp.
Right. Keep in mind, this is just strictly for C corporations.
Yeah.
But the goal, depending on when this would be implemented, if this goes into play in 2021, well, we kind of missed that boat. But if it doesn't go into effect until 2022, well, then the goal would be to accelerate as much of that income into 2021 as possible, rather than deferring it like we often are trying to do with things like depreciation and whatnot.
Correct. Let's see, and then book income potentially for if your financial statements, you get book income in excess of $100 million, you're looking at, you could say a 15% tax associated with that, or a minimum tax. All right, we're just gonna jump right into the Consolidation Appropriations Act of 2021. As you know, this bill was signed on December 27th of 2020, not too long ago. It provided a COVID relief as well as some spending for the government's fiscal year that runs through September 30th. Now, what's all included? We have second round in changes or modified to the Paycheck Protection Program. So round one money, or what we call it first draw loans, as well as now second draw loans. We have the expansion, extension of related COVID-related credits. You have your workers' opportunities tax credit. There's this employee retention credit that we'll cover later. There was the economic recovery payments, the second round, that $600 a person. And then we'll discuss some more provisions within that in later slides. And at the end of the day, the entire bill was around 5,000 pages. I think it was like 5,500 or something. So quite extensive, and a lot of provisions in there. So let's cover the Paycheck Protection Program. The big change here is that now PPP expenses are tax deductible. Now, prior to the pandemic legislation passed last month, the Treasury had some positions or announcements, back in May and November, stating that if you had a PPP forgiven loan, the expenses associated with that loan would be a non-deductible expense. Congress did not intend for that to happen. But in order for this to be corrected, Treasury's position said it had to be through legislation. Treasury could not just override what was currently in the code. So at the end of the day, on what was passed last month, legislation now clarifies, so expenses paid with forgiven PPP loan proceeds, and that applies for round one and round two. So you can see here, PPP one is what you like a lot of people got back in the spring and summer of 2020. as well as now the ongoing PPP2 or second draw loans. Just to let you know that expenses paid for that are all deductible. But are they? Now that's why I say with the last bullet, Wisconsin's position. Currently, Wisconsin is not agreeing to the expenses being deductible. So currently Wisconsin says for first draw loans, and right now lawmakers, just to let you know, are working on, maybe they're working on a bill to conform. We just don't know yet and where they're at. But just to let you know what it is today, Wisconsin's position is the expenses are non-deductible for round one money. The income, the forgiven income, that's still exempt, but the expenses you have to add back to your returns.
Right. And so even if you haven't officially gotten that forgiveness until 2021, let's say you filed the application in January, if you can reasonably expect that that loan is going to get forgiven, Wisconsin is going to want you to pick that up in 2020.
That is right. Thank you. Simplified loan forgiveness. So, loans now under $150,000, simplified the loan forgiveness applications. Now it's a one-page application, really no documentation required to submit. Just to let you know that, as well as, you want to retain your records for 4 years, your payroll records, your W-2s, the information for the application. Now, if you already applied for forgiveness and you already received forgiveness, you don't have to worry about this. But if, for round two money, just to let you know, for 150 and other, it's a little more easier to get that forgiveness submitted. Now, the legislation did add 4 new categories, non-payroll cost categories. That applies for not just PPP2, round 2, but also for round 1. But just to point out here, if you already applied for forgiveness and received forgiveness for your round 1 money, you won't have to worry about these 4 new categories. But just to let you know, these 4 new categories are your operations, such as, your accounting service, you got your sales and bills, HR software, delivery and processing. You have also covered damage property. So that would be like from public disturbances during 2020 that likely were not covered by insurance. So all those property damages, those are now considered non-payroll cost, supplier cost, and finally worker protection equipment. So maybe you have ventilation, you have to change the ventilation and filtration system. Maybe you add some physical barriers up. Those all can be considered cover or non-payroll costs, but part of the forgiveness application.
Right. And so this is all in addition to what was still there under the original CARES Act, which includes rent, interest on mortgage, utilities, and of course, payroll.
Correct. The flexibility for your covered period flexibility, as you know, it was either 8 weeks or was it 24 weeks? 8 weeks was the original covered period, when the CARES Act was signed in March. As then they came out with some more legislation to expand the covered period to 24 weeks. But it was nothing in between. It was either 8 or 24. What if you only needed 12 weeks or 13 weeks? Well, this legislation now allows you that flexibility where you can choose, well, I got 11 weeks, that's all I need. I don't need to include 24 weeks of payroll on my application. A big change and likely an opportunity that was mentioned, maybe with the ERC, they had employee retention credit that we'll discuss later. The payroll percentage, I mentioned a 40% for non-payroll costs. Well, that 60%, the other side is for the payroll, that still remains at 60. So if you got a $100,000 PPP loan, you still need to spend at least 60% of it on payroll, so 60,000. And finally, the economic injury disaster loan, that advancement that if you applied for and received, it was originally up to $10,000, and then there was some more guidance and saying, well, it's $1,000 per employee. Well, that was now repealed, and now it's not a taxable, event, because originally when you applied for the forgiveness on the first round money, you had to reduce your PPP loan by the advance, this EIDL advance that you received. Well, no longer that's the case. I do want to point out that if you did apply for forgiveness and you had an EIDL advance loan because of the CARES Act, the SBA and the lenders will reimburse you or get in contact with you to return that money. I don't have a timeline on that, but I would definitely reach out to your lender to discuss that if you had that situation. Farmers and ranchers, big change here. A change in the calculation. So at the CARES Act, before the legislation, you had to take net income of Schedule F. I think it was what, line 31 or 30? I can't exactly remember, but it was net, so gross less your expenses. Well, the legislation just passed. Now you can go take gross income, Schedule F line 9. So potentially, you had gross income well over 100 grand, which is limited to 100, but you can max out your loans to 20,833. And this does apply for your first round loans and now for second. But now first round loans, you're like, well, I already applied for forgiveness. It's already been submitted. I already got it accepted. Well, this planning for going back to round one is already, you can't do that. So this would be for those who have yet to file for forgiveness and so if you have this situation, I would definitely reach out to your advisor and just talk about, should I go back and get, increase or get money for round one to maximize the 20,000. Nick, any thoughts on this?
Yeah, no, this is a huge change. And, I've been helping some of our offices with some of these calculations, kind of central Wisconsin. We've got a lot of cranberry farms. And, for those, maybe they were showing zero taxable income on their Schedule F. Well, we can go back, if they had at least 100,000 of receipts, we can get them an extra of almost 21,000 for round one. And then we can simultaneously apply for round two and get them another 21,000 to get them close to 42,000. With just submitting a couple applications. And so this is huge for any farmer. So if you are a farmer, file on Schedule F, even a hobby farm, or know of anybody, this is a huge change for those farmers and ranchers.
Good. Yep. Another change to the calculation was seasonal employers. This just gives you a define what's a seasonal employer, but the big change is the loan amounts, what you base your loan on is on a any 12-week period between February 15th of 19 through February 15th of 2020. I do want to point out that the applications, not just for round one, if you want to go back to round one, and round two, the due date is March 31st, coming up on this 2021. Now the legislation did expand the eligibility as well, such as your 501c6 organizations, your chamber of commerce, leagues, and all that. But no professional sport leagues and no political or lobbying activities. There is a 15% test on your for the lobbying activities. So if you have questions on that, definitely reach out to your trusted advisor and discuss. I'm a 501c6, but I also have lobbying activities. Would I qualify? You definitely want to have that discussion to determine that eligibility. You also have nonprofits in there called destination marketing organizations, as well as from the eligibility standpoint, you have to have at least 300 or fewer employees. Now we want to cover second draw loans, or PPP2. It is available for what you could say the hardest hit small businesses. And what they're doing is, this is different from round one. And what the difference will be this 25% reduction in gross receipts test. That's not available for round one applications. This reduction in gross receipts is only available for round two. So you have to have this reduction test met. So just to cover it, you got to have employees of 300 or fewer. You must reach this 25% reduction test. The max loan is up only $2 million. And lastly, you will use or have used first draw loan money by the disbursement date of the second. So if you haven't, so the big key here is if you haven't received round one money, you can't get round two. So you have to, so if you had round one money, then you'd be eligible as long as you spend it or will spend it. Any comments, Nick, on just this slide here?
No.
Okay. So the next slide here, I just want to kind of show you that 25% reduction. So typically, if you're in operations, all 4 quarters of 2019, to calendar quarters of 19, you can compare any quarter of 2020, second quarter, third quarter, and compare it to the corresponding quarter of 19. So that's where you will look, this is where that 25% reduction test. Now, what if you were only in operation in 19 quarter 3 or quarter 4? Well, you can compare any quarter in 2020 and compare any quarter to either the quarter 3 or quarter 4 of 19. Now, if you started your operation in quarter 4 as well, you compare any quarter of 2020 to the quarter 4 of 2019. And lastly, what if you started, you weren't in operation at any point in 2019, but you were in operation, say January 1st of 20. Well, there you can compare quarter 2, 3, or 4 of 2020 and compare that to quarter 1 of 2020 for the 25% reduction test.
Right, and let me emphasize that if you were in business for the entire year of 2019, then that far left box applies. So the far 3 right boxes only apply if you started your business in 2019 or 2020.
I do want to mention some do-over provisions, what you could call it. So if you were a borrower for first round, this is really about first round money. So if you borrowed and returned all of it, because you're like, you know, this is too good to be true, you have an opportunity now to go back and receive some of that money or reapply and get that maximum amount that you originally intended. Or maybe you only returned part of the original funds. Well, then you can go back and maximize and get the difference from what you should have received versus what you did receive. So this is an opportunity, and this opportunity is available if you have not filed for forgiveness. So if you are still on that blocking, like I haven't filed for forgiveness for round 1, do you apply for any of these? You know, can I go back and increase my loan amount? Some modifications to the payroll costs, that 60%. There was no change to the 60% requirement, but there was a change to what is considered payroll cost. Group insurance payments are now considered, such as disability, vision, dental insurance. So you could potentially go back and increase your first round, get a higher amount because maybe originally you did not include these insurance payments. The employer part is as payments as part of the payroll cost calculation. So maybe you want to go back and increase your first round amount. But like I said, if you go back, if you already applied for forgiveness, you really can't go back. So that's going to be key. So have you filed and received forgiveness? I'm going to just briefly mention the employee retention credit. We're going to cover that later. But the employee retention credit, at the CARES Act, you were not allowed to do PPP loans or the employee retention credit, which is a payroll tax credit. Well, now the Consolidation Appropriations Act allows you to do both. The key is you can't double dip in payroll costs, but we'll cover that later. All right. Economic, we covered that, the EIDL earlier, but this is a slide. We'll just continue on. We do want to cover some more provisions in there within the CAA. Just to let you know, gross receipts, this is for that 25% reduction. What is gross receipts? Just to let you know, it's a sale of your products or services, interest, dividends, reduced by your returns and allowances. But I do want to point out, it's not, if you have first draw proceeds in your 2020 revenue, the forgiveness, you can exclude that from your comparison. Very important here. Just to let you know about calculations for decline in receipts. If you were in operation all of 2019, you can compare your 2019 on your tax return to the 2020 tax return receipts. So that's an alternative method than what we discussed earlier. Granted, 2020, we haven't filed yet, but at least you can probably talk to your advisor and like, well, I want to apply for second draw loan. You can at least get a prelim maybe on what you think your 2020 receipts will be and compare that to your 2019. Now, when you do submit your application for second draw loans, you do need to document this 25% reduction. You're going to have to provide it either at the time you applied for the application or at forgiveness. Here is just letting you know that for loans under $150,000, at the time of application, you don't need to supply that documentation, but you will need to supply that at the time of forgiveness. So either way, you have to do this test. The maximum loan amount is $2 million at 2.5. Now for restaurants and hotels, really a code, that NAISCS code that's you have begin with 72. Instead of 2.5, you get 3.5 of average monthly payroll costs. A big change here. There's a new form, the 2483 SD for application. It is available. Your lenders will know about it. Just to let you know, that does have all the certifications in there about the reduction in receipts. All right, I think we're gonna just move forward to, before we go to the ERC, have Nick highlight that. Just kind of the big takeaways here. The cover period flexibility is 8 to 24 weeks or in between. There's additional eligibility expenses. Those are that covered expenditures in addition to the rent, interest, and utilities. Simplified loan forgiveness. You can now go back and amend your original application to increase your first round loan, but if you already received forgiveness, you can't go back. PPP expenses are now deductible. Wisconsin currently does not allow, as well as the economic disaster injury or the little advances, those two, just to let you know. There's going to actually be difference of treatment for federal and state right now. That could change. We just don't know yet, but as of now, there's no conformity. Okay, Wisconsin treatment, just quickly to mention those grant programs and the PPP. Remember that we're all in grant funds that you got from the state, could have been like $5,000. Those are taxable for both federal and Wisconsin. And the expenses associated with those grants that you paid for those are deductible. And now let's go to the employee retention credit.
All right, so the employee retention credit. So it's not a completely new concept. So this has been around for a number of years, available for certain disasters. A hurricane hits Florida or something. So those in the disaster area will qualify. But for most of us, it is new. And Congress has really expanded and ultimately said everybody kind of falls in that disaster zone. And so it essentially applies to everybody that qualifies. So it originally came in under the CARES Act, signed last March, and then under the Consolidated Appropriations Act, it was really expanded so that, under the CARES Act, you could only take either the PPP or the retention credit. 95% of the clients that I work with opted for the PPP, and so nobody really talked much about the employee retention credit. So now the new act really expanded that and let us apply or retroactively apply the employee retention credit or allowed us to take that. So, okay. So significant changes. Just a high overview, the credit provides a payroll tax credit for qualified wages paid to employees, which, as I mentioned, can be applied retroactively by PPP recipients. But it's very important that we cannot double dip on wages. For 2021, the 100 employee threshold increased to 500 employees. For 2021, the required decline in gross receipts reduced from 50% to 20%. And then increase the credit by 50% per employee to 70% of $10,000 per employee per quarter for wages from January 1st of 2021 through June 30th of this year. And we'll get into a little bit more detail on that. So just a quick example to show you the power of this credit. So let's say you as an employer employs 10 employees making $40,000 per year, 10,000 per quarter. Let's say your gross receipts are down by 20% in 2021 as compared to 2019. The credit calculation. So we have $10,000 per employee available times the 70%, getting us a $7,000 credit per employee per qualifying quarter. So with those 10 employees, that's a $70,000 credit. If you qualify, well, really, if you apply for we'll get into the second quarter. So essentially if you qualify for one quarter, you essentially piggyback on the second quarter then. So in that example, we'd be looking at a $140,000 credit in this example. And so we're talking big dollars. So something we don't want to overlook. So let's take a step back and look at 2020. So there's kind of two different sets of rules for 2020, applying it retroactively, and then looking forward into 2021. So for 2020, eligible employers will receive a refundable payroll tax credit for up to 50% of wages paid to employees after March 12th of 2020 through December 31st. So there's kind of two requirements. One is the operation was fully or partially shut down due to an order from the government. And we'll get into kind of what qualifies as that. Or alternatively, we had gross receipts that are less than 50% of the gross receipts for the same quarter in the previous year. So maybe we'd be looking at second quarter of 2020 to second quarter of 2019. If we had that 50% drop in receipts, then we can qualify. Now in 2020, the wages are limited to $10,000 per employee for a max credit of $5,000 per employee. An average full-time employees greater than 100 wages paid to employees are only for performance or not performing services are eligible for the credit, meaning that only the employees that aren't actually working qualify for those credits that you're still paying. So that's for 2020. For 2021, the credit was really expanded. So that's starting January 1st through June 30th. So eligible employers will receive a refundable payroll tax credit of up to 70% of wages paid to employees. Under kind of the same, if we had the government shutdown, although right now I'm not aware of anything for 2021, but then the gross receipts test changed. So instead of the 50% test that applied to 2020, now you only have to meet 80% of the gross receipts for the same quarter in 19. So we're still comparing to 2019. So we'd be looking at first quarter of 2021 to first quarter of 2019. So if your receipts are less than 80%, you qualify. The wages are limited to $10,000 per employee per quarter. So rather than in 2020, when it was for the full year, you get to qualify for that per quarter. Okay, so that'd be $7,000 per employee. So let's take a look at that definition of partially or fully suspended operations. So in order to qualify here, a business must actually be limited by mandates. So what orders qualify? Well, the federal or state orders, if they limited commerce, travel, or group meetings, et cetera, et cetera. Here in Wisconsin, we're really looking at the Safer at Home Act or Safer at Home order that came into play, around March 17th through May 13th about time frame, and then there might have been a sliver of time in October there then. So what about essential businesses? Well, that really depends under facts and circumstances. So let's say you are an essential business, but part of that business was limited. We're really going to have to take that on a case by case, because everything's going to, it really depends. So for partially suspension, eligible employers continue some, but not all of their trade or business operation. So if you're able to telework, there really is no suspension. So for example, us CPAs, when everything shut down, we were sent home, we're still able to do our thing. And so that's not going to qualify. So the operation must not be able to continue in a manner comparable to operations before COVID. So modifications to the operation must have more than a nominal effect. So what is a nominal effect? Well, the IRS does not really define it. So we're going to have to use some judgment here. So let's take a look at some examples. Let's say you're a car dealership open for business and customers are under the stay-at-home order, causing a significant decline in sales of automobiles. Well, is that a full or partial suspension of operations? No, there is no full or partial suspension of operations. You could, however, still qualify with the 50% dip in revenue, applying the 2020 rules, but you're not going to qualify for being partially or fully suspended. Now, what about a restaurant that had indoor seating that had to close? And let's say you still had takeout or delivery service. Well, yes, that would be partially or fully suspended, because a big part of your operation is changed. You're not able to invite customers in, so you would qualify. So let's take a look at qualified wages. So that includes wages paid to employees, including certain health plan expenses. When the reduced revenue requirement is used, so you had that either 50% reduction or 20% reduction in 2021, it includes wages for that entire quarter. However, when you have the full or partial shutdown requirement that's being applied, it only includes wages that are paid during that shutdown period. And so usually, if you can, we're going to want to apply the reduced revenue requirement. And if that doesn't qualify, then we'll have to look to see, okay, well, were you shut down for a period of time? One important thing to note, however, is that the calculation excludes wages paid to related family members. So if you're a business owner and you have your kids, grandkids, parents, grandparents, siblings, aunt, uncle, niece, nephew on payroll, those wages are not going to qualify for the retention credit. But as we've said several times before, we can't double dip on PPP, but what you can do is shift those wages over to the PPP forgiveness to optimize there while keeping all your other wages on the employee retention credit. So that we can do. So really the next steps is for 2020, determine the eligibility of the employee retention credit. Did you have a partial shutdown or full shutdown? Or do you meet the 50% reduction of gross receipts for 2020? If yes, do you have any qualified wages? Another important factor then, I guess, is have you submitted your PPP forgiveness application? And if you use those wages for the PPP application forgiveness, we can't use them in the employee retention credit. And so we might be out of luck. However, you still might have some wages available. If you have not completed your forgiveness application, well, then you have to sit down and really try to optimize, how wages need to be allocated between the two programs. So then how do we report the credit? Well, for 2021, we can simply claim the credit on Form 941 when we file in April. For 2022, it's a little bit more complicated. I think we still need additional guidance, but as we sit today, we think that you need to go back and amend each of those 941s for 2020 to claim those credits in the applicable quarter. So Chris, I don't know if you have any thoughts on that.
Yeah, I just, with the quarter just ended now for fourth quarter, 3 days ago, there was an opportunity, I guess, opportunity to catch up, like, oh, I missed second and third. Well, I guess at the end of the day, we're just waiting for guidance to really narrow down how to apply this credit, especially for those taxpayers who have both the PPP and they took the money, PPP borrowers, and then if they are eligible for the ERC. So we're aware of it. We're just continuing waiting for IRS, and they're backed up and they're doing their best. So once we know, we'll let everybody know how to apply these rules. Okay, so I want to, not too long, just talk to you about the Shuttered Venue Operating, these new grants called Shuttered Venue Operators or Operations. It's a new grant program. As you can see here, it's some significant dollars based on 2019, and it is administered by the SBA. I do want to point out here that we are still waiting for guidance. We really have no clue how to apply or what the application looks like. But the key here is, if you have PPP or you borrowed PPP money, and this is borrowing after December 27th of 2020. So if you were one of those, you're not eligible for this grant. If you had PPP money from before, like before December 27th, when you grant, back in the summer, you're eligible for this grant. So it's very important that you talk to your trusted advisor if you are potentially eligible for this grant, such as, if you're a live venue operator, are you a movie theater, performing arts organization, and so forth, or a relevant museum. So very important here. So talk to your advisor on this. Just to tell you who's eligible, just mentioned, we got relevant museum operators, zoos, live performing arts, live venue operators, talent representatives, all are eligible for this grant. Here's a little description on what's a live venue operator, a relevant museum. I just say right now, this is a good opportunity. If you fall under this eligibility, and if you haven't applied for PPP2 or PPP1 in general, anything after December 27th, this could be an opportunity for you to get a bigger chunk of grant money. Now, there are some requirements. You have to be fully operational by February 29th of 2020. You've had to at least have gross revenue from during quarter 1, 2, 3, or 4 that was less than 75%. These are quarter ones of 2020 comparable to the 2019 quarter. Can't be a publicly traded entity. Can't receive more than 10% of revenue from federal funding. If the date of the grant, maybe you're closed, but you plan to or intend to reopen, you got to be that. You have to plan to reopen, and lastly, you cannot receive or applied for PPP round 1 or second round after December 27th. The use of the funds, you can use, if you get the grant, you have an expanded time all the way through December 31st to spend it. Now, allowable expenses, very similar to the PPP, but you see payroll, mortgage, rent, interest, and other ordinary business expenses, which is that's not part of the PPP, but you can see that the allowable expenses is a little more broad, but you can't use it for real estate purchases, lobbying, or investing. Okay, we got about 5 more minutes to go, and then we're going to give some 5 minutes for Q&A. Just around here, economic stimulus payments, as you know, the first round was about $1,200 per adult, $500 for dependent for children 16 years and under. Second time around, $600. That includes dependent, still 16 years of under. There is a phase-out range. And so likely you probably already received the deposit checks, maybe by deposit, or the check is in the mail. there is some, I've heard, I'm sure Nick, you've have talked to some clients. I haven't received it yet. And likely if you haven't received it yet, and if you go to even the IRS tool that they have, and if you get the status number 2, it says not available. What they were saying is you have to apply or file your 2020 return to get the recovery payment. This is definitely a sticky, if you have situations where, I would say in the end, just talk to your advisor and like, why didn't I get my stimulus payment? Because there's just, it's a very, I would say complicated. You feel like it's easy, but it is, I'd say complicated on why you didn't get it, because there could be a lot of reasons why. So just to let you know, for somebody who passed away, if you passed before January 1st, 2020, you weren't eligible for the second round, but if you did pass after January 1st, you are eligible. First round you have to have a valid social security number. If you're first round and one spouse did not have a social security number, only the one spouse would have received it. So, or actually in this case, no payments for both. But the second round, if one spouse did not have it, but you had a valid, you would have received the payment. So some slight differences between the first round. There is a lot of, I would say if you have questions, talk to your trusted advisor. The IRS is constantly updating their IRS site, an FAQ, frequently asked questions on this topic. And as well as the IRS has a good tool to check, or at least check if you're going to get the check. But supposedly I've heard that they're going to create an online tool to determine what amount, what did you receive? Because you're going to need to know this when you go and file your 1040 for 2020. Unemployment as well as $300. Unemployment, as you know, CARES Act was $600. This $300 will expire, $300 a week will expire March 14th. Educator expenses for those who are teachers, we know that the max is $250 above the line deduction. Well, they're just expanding what's eligible. So it's such as personal protection equipment is now unreimbursed. So supplies really for the prevention of COVID. Still, it's $250. They didn't increase it. It just expanded the category. One on here, the charitable contributions for non-itemizers, so your cash only donations for 2020, if you contribute to let's say a nonprofit, your church or Goodwill, and it's over $300 of cash, and it has to be cash, you get a $300 deduction if you're a non-itemizer. So if you don't file a Schedule A. Now I do want to say that for 2021 tax returns, we got another 12 months for that. That contribution is $600. So it was $300 and is $300 for 2020, but now for 2021 tax returns, it increased to $600. Let's see, the earned income credit, there's an option here. So the earned income credit is a complicated credit, but the option here is that you can go back to your 2019 income levels to determine your 2020 earned income credit. Just to let you know that. So if you have an earned income credit, this option is out there for you. A big one here for business meals, starting for calendar years 2021 and 2022. So this is not for 2020, but now if you have meals or beverages provided by a restaurant, and takeout is okay, for 2021 and 2022, 100% deduction is allowed for expenses paid or incurred. Like I said, it doesn't apply for 2020. So, when we're applying for returns now, it's still 50%, but for next year and the year after, it's 100%. All right, so we got about 4 minutes left. So open up for any questions. Any questions now?
If you don't feel comfortable reaching out to us in front of everybody, feel free to shoot us an email after the fact. and let us know your specific question. We'd be more than happy to at least give you a high level analysis on your particular situation, and we'll go from there.
And yes, to add on to Nick, we have our emails here. You can reach out to myself, Nick. We also have an email dedicated for COVID. So if you want to reach out to the COVID team here at Kerber Rose, feel free. Then we also have a resource page that we always up to date. So if you want to find more information.
And now will the presentation be available for the attendees then?
Yes.
Okay,
Yep.
perfect.
So I got the slides from Autumn and we recorded. So we'll put the recording out and send the slides out to everybody that attended.
Perfect. So when you're reviewing, if you have any questions, I know we went through a lot fast, but there was a lot of good information there. We try to put as much information on the slides as possible so that you can go back and reference, you know, more specifically on what we were talking about. But if you do have any of those questions, again, feel free to reach out on those.
Good. It looks like we are all set. Thank you so much, Chris and Nick, for all the information. I know we learned a lot. And again, the slides will be sent to everybody and link will be on our website. Thank you, everyone. Have a good day.
Thank you. Thank you, Mickey.
Yep.
Thanks.
Bye-bye.